Well, welcome everybody to this week's edition to Reverse Mortgage Weekly, where we go over all the ins and outs of the reverse mortgage program, or at least enough to whet your appetite in regards to the program and to learn a little bit more about how people are using this and how it works, how it doesn't work, what it is, what it isn't. I'm your host. My name is Zach Smith. I own Chariot Financial. I've been in the mortgage and real estate industry for 20 years, and I've been making reverse mortgage a big part of my business, and it is the bulk of our business right now for the reverse mortgage um, uh, for some time now in regards to where we're sharing. Sorry, I'm a little distracted because I think I'm sharing the wrong screen, but that's okay. That's on a different program there. So yeah, thank you for joining in. We're going to go ahead and jump right into it here. So once again, my name is Zach Smith. I own Chariot Financial. If you want to learn more, you can go to chariotreverse.com. So one of the things that people talk about with this program, let me just having some technical difficulties here at the moment, but we're just one click away from everything just working just fine here. So so let's see here. Okay, here we go. Let's go ahead and we can just back up a little bit. So, if you're looking to find out a little bit more about who qualifies for a reverse mortgage, well, it's someone who is 62 or better, some 55 in some cases. It has to be your primary residence. So you have to live in your property for at least 1 month and a day. So it has to be something where you're considered your primary residence. Most of these programs are FHA programs. So there are also some like traditional reverse mortgages that aren't FHA programs, but those haven't been as popular as of late because once rates have increased, those programs became less desirable. So FHA is by and large the best program, in my opinion, that's available, just because it offers so many protections. And one of the things that people talk about this program is that there is an upfront mortgage insurance premium with this program. So if your house is worth $400,000, they're going to charge you $8,000 at closing for that upfront insurance premium. And I know that's something I'm supposed to say last, right? Talk about all the bad stuff last. No, we're just going to go right out with it. And that's one of the things that that people don't like about this program is that it can, in some cases, be expensive, and people look at that and they say, "Oh my gosh, that's such a bad deal. They're taking advantage of seniors, things like that." But the fact is that that's an FHA thing. That is not a reverse mortgage thing. So folks who are first-time home buyers, people who are a couple of years out of a bankruptcy, lower credit scores, who do just a regular FHA, first-time home buyer, whatever program, they're still going to get charged that fee as well. So that's one thing that I really want to impart. And the reason I'm doing some of these webinars is I really want the truth to be out there so that people can make an educated decision, because there's too much bad information out there about these programs. So that's the thing about the upfront mortgage insurance premium with the FHA type programs. So, you do need equity and a large down payment. So, or a large down payment if you're purchasing property. So that's another thing to keep in mind, is that you do need quite a bit of equity to qualify for these programs. The risk assessment on the reverse mortgage is completely different than it is on a forward mortgage. On a forward mortgage, if you borrow money from the bank, the first thing they ask you is, how are you going to pay us back? So what they do is they look at your income, they look at your assets, they look at your credit, and they say, look, okay, we're going to determine, if we lend you this much money, are we going to get our money back? Well, with the reverse mortgage, you don't have a monthly payment that is required. It is optional. There is a monthly payment, but it is optional. So what that means is that the risk assessment is completely different than it is on a forward mortgage, because there's no monthly payment. So what ends up happening is the risk assessment is based on the age and also the equity in the home. So that's why that's one of the big factors in qualifying for a reverse mortgage is that you do have to have equity. So minimal income qualifications, I know the risk assessment is different, but they still need to verify that folks have enough income to cover um, their expenses monthly, the maintenance, the taxes, the insurance, HOA. They need to make sure that those costs can be covered and that you have a little bit left over after that. So, much different qualifications than a forward mortgage because there's no required monthly payment. It's actually much harder to qualify for a forward mortgage than it is if you have equity and you're of age than it is for a reverse mortgage. So, what does that financial assessment look like? So, the purpose of the financial assessment is to determine the willingness and capacity of the customer to meet their financial obligations. You notice they're not talking about mortgage payment in there, and that's something that they would talk about otherwise. But what they're talking about is basically making sure that you have residual income, property charge payment history. So they're going to be looking like for an HOA. If you live in a property with an HOA, they're going to be looking at a 2-year history of those programs of your history for your monthly payments. Also credit history as well. So in the case that you do not pass that financial assessment, basically what they're going to do is they're going to offer what's called a life expectancy set aside. Keep in mind, these programs are a lot like life insurance products because they have what's called a residual or they have what's called actuary tables that they use to determine what people qualify for. So for instance, someone who is 62 can qualify for less than someone who is 82 because they're basically planning that the person who's 82 to be in the house less time. So they offer a more equity during that time period. So the life expectancy set aside is basically a real fancy name for an escrow account. So they're going to take your taxes, your insurance, put them into an account where you can pay those basically for a certain amount of years, depending on what they think your life expectancy is. It's actually not a bad deal for folks because then, with the reverse mortgage, mainly you have a payment that is optional. So if you want to skip your monthly mortgage payments and just let it accrue interest over time, you can absolutely do that. And something to note about that, a lot of the critics of this program say, oh, it's a bad program. It's negatively amortizing. People go upside down on their houses. First and foremost, yes, you can go upside down, but it takes a really, really long time because we have to account for all the equity that you currently have. So we're talking in a healthy market. That means, average interest rates, home appreciation at 4%, you're probably looking at about 50 years to go upside down on the property. So that's one thing to keep in mind. Number two is that basically if you go upside down on the property, that is really a choice. You can still make a monthly payment on a reverse mortgage. It's just not forced for the person to make those payments. If you choose to skip the payment, which 99% of my clients do, because you can make the monthly payment, you can treat it just like a normal mortgage, you can pay it off, you can do whatever you need to do with it. But the reason most people decide not to make that monthly payment, let's look at amortization just as a whole. So, people who refinance into a 30-year fixed, even with people with low interest rates, did you know that you're paying 50% of the interest up front for those 30-year fixed loans? So a lot of times when we're making our mortgage payments on a 30-year fixed loan, most of it is going right to the bank anyways. It's going right to paying the interest. And I'll give you a quick example. At 6 1/8%, $600,000 loan amount, your principal and interest payment that first month is going to be $3,600. Guess how much of that is actually going to pay off the loan? $600. $3,000 of that $3,600 payment is going right to the bank. Right to the bank. And that's at 6%. That's about an average interest rate. That's kind of low for today's day and age, unless you buy it down. But But the fact still remains that a 30-year fixed mortgage, the deck is always going to be stacked against the consumer. So a lot of my clients look at that and they say, look, I'm taking my retirement and I'm putting it into paying off this loan, and most of it's going to the bank. Well, heck, I'd rather take that money that I'm making a monthly payment with, and I'd rather take that and put it in my pocket. So that's something to think about when you think about the reverse mortgage. So, but to get back to the financial assessment and the LISA account, it's life expectancy set aside, fancy name for an escrow account. Basically, people would be able to be in their homes, and if they chose not to make that monthly payment, we would be paying the taxes, the insurance, and they wouldn't have to really worry about making any payments at that point. I have a lot of older men that come to me to do these mortgages that are married because they want to, women have figured out how to live a little longer than most men. Life expectancy has always been a little bit higher. Men, we're tough guys. We don't go to the doctor. We don't talk about our mental health. We associate with who we are with what we do. So when we retire, we have the existential crisis and things like that. Women have learned how to take care of themselves a little bit better. So I have a lot of older men that come to me, and they do these programs for this very reason. They want to make sure that in the event that something happens to them, that their wife is going to be in a situation where she can live in the property for the rest of her life and not have to worry about making a monthly mortgage payment. Having that peace of mind that you're going to be able to have a place to live is really, really a big asset right now. And, I get on my soapbox with my first time home buyers, talking about buy real estate. You buy real estate and you wait. You don't wait to buy real estate. And I know folks are out there saying, oh, I'm not going to try to push you to buy. I'm not going to try to push you to buy either, but my advice would be is to buy real estate. If you're thinking about it, do it. Because a lot of times what will happen is, and I heard a mortgage broker talking about this today, about saying, oh, it's fine to wait. I don't know. I disagree. And I'm going to push back a little bit because I think once rates go down, I think prices are going to shoot right back up. So it's more of a strategy than it is an opinion. So I digress. Let's move on here. So reverse mortgage information, the FHA administers most of these programs. They call it the home equity conversion mortgage is their name for the reverse mortgage. According to the U.S. Department of Housing and Urban Development, more than 500,000 households across the nation are using reverse mortgages right now. The amount of money available by a reverse mortgage, again, is determined by the youngest homeowner. They use actuary tables to determine how much they will be able to offer you. Also, interest rates. Some people didn't realize that, the increase in interest rates affected reverse mortgages. They lend out less money now. Also, the value of the home up to the maximum allowed lending limit. The index, a lot of these programs are adjustable rate programs. And I know a lot of people hear that, oh, it's adjustable rate, it's a bad idea. Well, yeah, on an adjustable rate on a forward mortgage, if your rate adjusts up, you got to come out of pocket. You're going to have to rebudget if the rate goes up. And a lot of people are experiencing that with home equity lines of credit here. When the Fed decided to just start raising rates, their payment was going up exponentially each time they did that. We had a home equity line, and when we started, it was at 6. And by the end of the Fed raises, it's at 10%. So it's one of those things where, on a forward mortgage, an adjustable rate is tough because you're going to be feeling it out of pocket each month. Well, with a reverse mortgage, if you choose not to make those monthly payments, yes, the interest is accruing higher each month, but you're not going to feel that out of your pocketbook. The peace of mind that this program offers most people is just astounding. And that's why one of the reasons that this program is so popular right now and why I'm trying to get the good word out. So what are the benefits of the reverse mortgage? Well, you still get to keep title to your home. So, that's one of the big myths about this program that I hear. Oh, well, the bank is going to own your house. How does that even come into play? I mean, that was never a situation. Now, there are situations where people have gone upside down on reverse mortgages, especially the traditional ones that were being originated 10 to 15 years ago. Now, those didn't have the same protections that FHA has. So, yes, that I can see why people would see that and say, oh, well, that's just a way to take your house. Well, it's not a way to take your house. Believe me, the bank doesn't want your house. It's a big problem for the bank to own real estate. And how do we know that? Well, let's look at 2008. Back in 2008, the banks were in a really tough position. It was a really hard time for people back then because people were losing their jobs. Real estate plummeted. The movie The Big Short, kind of explains the whole thing. Back then, if you could fog a mirror, you could get 100% financing. And with that 100% financing, if you had a good credit score, then they would tell the investors on the back end, oh, we got a AAA rating here. But really what those loans were 100% stated income. What does that mean? You don't have to prove your income. You just say, oh, I make $1 million a year. Okay, sounds good to me. Let's give you 100% financing. That and the 228 programs, the programs that were subprime programs. They'd have a program where you're fixed for 2 years and a three-year prepayment penalty. So they lock you into that 1 year because it's fixed for 2 years and then it skyrockets right after that. And you're forced to make that third year payment. Well, a lot of people weren't able to do that. And that's how that started compounding with the option arms. Anyway, so tough time back then. But right now, if we do have another 2008, a reverse mortgage is by far the best mortgage program to be in because of its non-recourse feature. That means you're never going to owe more on the property than what it's worth. And basically, the money is collected at the end. The bank gets paid out at the end. Our buddy Tom Selleck, he's out there with, talking about reverse mortgages. And one of the things he's quoted as saying is, the reverse mortgage is just like any other program. The only difference is how you pay it back. And that's exactly on point. Our buddy Tom Selleck and his legendary mustache hit it right on the head because the reverse mortgage is just like any other mortgage. It's just that the way you pay it back, you can pay it back monthly if you want. I mean, there's no problem with that. Or you can wait till you vacate the residence. Now, what does that mean? Whether you move out of the property and it's no longer your primary residence, it has to be your primary residence. So if you want a snowbird, no problem. We've had folks, purchase vacation homes with a reverse mortgage. And the beauty of that is that the payment's optional. So now, the vacation home, they can rent out Airbnb, get cash flow that way. And instead of putting that money back into the property, they're putting it into their bank account or into their investments. Or the other way is if you pass and it's no longer your primary residence, then at that point they would want you to pay the loan off. But one of the things that a lot of people don't talk about enough about this program as well is when that situation happens. I teach classes for the state of Colorado for real estate agents for the continuing education. I've been teaching this class for about 8 years now. And I had an agent that, they knew we've kind of making a name for ourselves here in town as the purchase people for reverse mortgages with real estate agents. So I had an agent call me and said, hey, one of my clients called and, her mother just passed and, we don't want to tell the lender because she's got a reverse mortgage and we don't want them to foreclose on it. And I'm thinking to myself, my gosh, you need to take my class, buddy, because that's not the case at all. Once that situation happens, you get 6 months to determine what to do with the property. And then if the family still needs time to determine what they want to do with the property, they can get 2 free 3-month extensions. So a total of 12 months to decide what to do with the property when someone in that case passes. Well, if you have a forward mortgage, if you're late 3 months on a forward mortgage, they can initiate the foreclosure process. And what people don't realize, at least this is how it works in Colorado, what people don't realize about the foreclosure process, and I have extensive knowledge about this because during 2008, I was working in the loss mitigation department with JP Morgan Chase. But if you go delinquent 3 months on your mortgage here in Colorado, they can initiate the foreclosure process. And then to get it out of the foreclosure process, a lot of times they don't want to negotiate. They want all of those missed payments paid back all at once. Now, the banks have gotten much more lenient with offering modifications and things like that. But my gosh, sometimes it's really tough to work through that situation. And in a situation where you have someone where you're not on the mortgage, it can get really hairy trying to pay that deficiency. Most people just end up selling the property in that case. But the difference is that your family is going to have a lot more time to decide what to do with the property than they would with a forward mortgage. The other thing is, if we have another 2008 event, because this loan is a non-recourse loan, you're never going to owe more on the property than what it's worth. So it would be the absolute safest program to be in if we had another 2008 event. So you still get to keep title to your home through that whole thing. The bank never comes in and takes your title. Yes, they place a lien on the property, but that's the same thing they do with any of the forward mortgages, is they place a lien right on the property. So it's no different than a forward mortgage in that sense. So basic credit income qualifications, tax-free cash from equity, 30 to 74%. Now, the reason we say tax-free is that if you choose to get what's called a tenured option, basically converting your home into an annuity, like an annuity. It is not an annuity, but it is like an annuity, where in the sense that it's paying you back each month. You can certainly do that. A lot of people don't choose that option, but if you chose to do that, it would not count as income. Or if you took out a line of credit and you withdrew and bought yourself a Maserati or whatever you decided to do with the funds, pay for medical bills, credit card bills, grandchildren tuition, the list goes on and on and on of how you can use that equity to your favor. It's not going to be taxable because it is considered a loan. Same thing with qualifying for Medicaid and things of that nature. Monthly payments, again, are optional, still responsible for taxes and insurance unless we set up that LISA account that we talked about earlier in the program here. So why is a reverse mortgage a bad idea? I wanted to do a little research, just to find out where some of this information is coming from about the reverse mortgage. And, discovering what I have found the two biggest myths that people have is that you lose title to your home. That is not at all. It's not even remotely close to how the program works. You don't lose title to your home. You still have the title to your home. You still own it. It's your title. The other thing is that you're upside down on the property after you take one out. It's a very slow process to go upside down with a reverse mortgage. Again, in healthy market conditions, we're talking 50, 60 years for people to go upside down, maybe even longer than that in really healthy, robust markets. But if we have another 2008 event or rates jump up to 15%, well, that's going to change things a little bit. But in healthy, normal market conditions, it's going to take a really long time for people to go upside down. But, it's kind of like asking the farmer, he plants his crop and then he goes out the next day. Oh, where's my crop at? No, it doesn't happen overnight. This is something that happens a long time. And again, it is a choice. If you want to continue to make monthly payments, you can. Again, most of my clients choose not to because they see the value in keeping that money in their pocket and not handing it over to the bank. So your heirs inheritance, this is one thing, probably one of the big issues that, and this is an article I pulled off Investopedia. It's a trusted source, people go there online. They're supposed to be giving some sound financial advice. So let's dig into it. Let's call them out on what we're seeing here. So taking out a reverse mortgage could complicate matters if you wish to leave your home to your children who may not have the funds needed to pay off the loan. Again, that could happen with any mortgage. That could happen with a forward mortgage or an all-in-one simple interest mortgage, a HELOC, or anything. So they're posing this question or this negativity as if the reverse mortgage is the only thing that is the only barrier like this, where in reality it's any mortgage. But I'll go on here. While a traditional fixed rate forward can offer your heirs a funding solution to secure ownership, they may not qualify for this loan, which is in case a cherished family home may be sold to a stranger in order to satisfy a reverse mortgage debt. Again, this is something that could happen with any mortgage. It doesn't matter if it's a forward or a back, a forward or a reverse or a home equity line. In the event that you pass, your heirs would have to sell the property or satisfy that debt or refinance that property into their name. So that's something that would be true if it were with any mortgage. But there's a unique feature again. One is that it's non-recourse, so you're never going to owe more on the property than what it's worth. Let's just play devil's advocate here and say that meteor hits the earth tomorrow and you end up owing way more on your property than what it's worth. Let's say you owe 400 and the house is worth 300. Well, at that point on a forward mortgage, your heirs would basically have to do a short sale, or they would have to give it back to the bank. Well, on a reverse mortgage, because you're never going to owe more on the property than what it's worth, that amount is not going to, they're not going to come after any deficiency or anything like that, because that's in the paperwork that says that it is a non-recourse loan. The other thing is that FHA will actually sell that property back to the heirs for 95% of the appraised value. This is not talked about enough about this program. So let's say you owe 300, the reverse mortgage is at 300, and no, let's say you owe 400. I'm sorry, you owe 400, and your house is worth 300. So you're upside down, $100,000. Well, at that point, FHA will actually sell the property to your heirs for $285,000, even though you owe 400,000 on it. They will sell it to the heirs for 95% of the appraised value. So that's a huge benefit if we had like a 2008 or something like that. That's one of the things I bring up a lot when I speak about this program, is that if we have, I lived through 2008, lost a job, had to, reinvent myself and work for other people and, just find a way to survive during that time. It was a really tough time for a lot of people. So during that time, if you were in a situation, a lot of times if you did a short sale on your house, it was, there were some banks that were sending out 1099s for that deficiency. So, you owe 300 or you owe 400, it's worth 300. You sell the property, people get a 1099 from the bank saying, oh, that $100,000 that was a short sale on the house, well, you owe us that money, or you got to pay taxes on it. You get a 1099 for it. So they looked at it as income. So bad situation. But with a reverse mortgage, in that situation, having it be non-recourse, meaning that they're not going to ask for any deficiency, and they're willing to sell it back to the heirs for 95% of the appraised value. What an incredible insurance that you can have to ensure that your heirs don't get stuck with any debt or get stuck with a property that they're having a hard time sell. So if you live with someone, this is another point that they brought up in their their article, that is basically why a reverse mortgage is a bad idea. And basically says if you have friends or roommates living with you and they're not on the loan paperwork, they could conceivably land on the street after your death. Oh my gosh, they're making it really sound bleak. And it's true. It is true that if you have people that are living with you that are not on the loan, it's going to be a precarious position for them to be in if you pass. That's not just with a reverse mortgage, though. This is something that if you had any type of mortgage, again, any type of loan, if you pass and the people aren't on the paperwork and they live with you, it's a precarious position. They'd have to qualify, or if they were rightful heirs, then they would be looking at refinancing the property or selling the property. If they were just roommates that you had sharing a room, then at that point, there's really not a whole lot for them to do. And that doesn't matter if it's a forward or a reverse. It's really the same situation. Again, you do have to live in the property for 6 months and a day. So those boarders may be forced out to vacate the home if you move out for more than a year, because reverse mortgage requires the borrowers to live in the home. That is true. That's one of the things about this program, is that it does have to be your primary residence. So if you move out, you say to heck with this, we're going to Costa Rica and going to live out our retirement there, they're not going to allow you to keep the reverse mortgage. That would be considered a violation of your contract with the bank. And also, you can't list different people on the mortgage. You have to be in either a marriage or a recognized civil union for the reverse mortgage. So I hope you found something useful out of this. I try to do this every Wednesday, rain or shine, here from Zoom, streaming it out onto Facebook and also onto YouTube. So feel free to subscribe to the channels. And if you have questions for me, you can reach me any time of the day, 24 hours a day, 7 days a week at chariotreverse.com. I hope you have a great rest of your day. Thank you so much for joining me.